Hello, everyone. Thank you so much for taking some time out of your busy day to join this quick webinar on the European Industrial Outlook for 2019. My name is Alex Dresovsky, and I am the Director of Speaking Services here at ITR Economics. So when we look towards Europe and our expectations for 2019, I think it's important to put that into some context relative to what we expect for the United States. So the first thing I want to show you is our expectation for what happens in the US industrial economy this year. I'm showing you data for US Industrial Production Index in this slide in two different ways. On the left-hand side is the 12-month moving average for the US Industrial Production Index plotted over time, going all the way back to 2007. On the right-hand side is something we call the 12-12 rate of change. That's the year-over-year growth rate plotted on a rolling average annual basis. And you can see here this dip in 2008, 2009, that was the Great Recession. That had a very negative impact on the US industrial economy with a contraction of nearly 14% at the low point in 2009. You can see another rate of change decline here in the 2015-2016 timeframe. That recession in the US industrial economy can be easily connected to the collapse in oil and gas prices from over $100 a barrel to just under $30 a barrel at the low point in early 2016. And we can see that this rising trend that the US industrial economy has been in terms of its rate of change improvement over time, is really uncharacteristically long. So when you typically see a period of accelerating growth in the US industrial economy, on average, that's usually lasting somewhere between 13 and 19 months. But this period of acceleration that we've been in has now lasted more than 30 months. And so that's really almost record length in terms of the accelerating movement in the US industrial economy. So I hope you have all enjoyed the ride over the course of 2017 and 2018, because as you can see based on our forecast here, we are expecting the peak in the US industrial economy to occur imminently. Our timing expectation on that is of a peak in the first quarter of 2019 and deceleration over the course of the year, eventually yielding some mild negativity. That's what our teal bars in the forecast represent. So although right now, year over year, industrial production is up 4%, we are expecting a slowdown to just 0.5% growth by the end of 2019. As you can see, we're also calling for some mild negativity. The first half of 2020 is expected to have at least 2 quarters of sub-zero performance, meaning a recession by economic definitions. But that recession is going to be very mild and very short-lived. And by the end of 2020, we'll be back up into positive territory. You can see our forecast calls for 0.7% growth in that year as a whole. And so essentially what you should be planning for is 2 relatively flat years in both 2019 and 2020 with some mild negativity becoming quite visible in the first half of 2020. But the good news here is that the acceleration will return by the end of that year, and that will carry us through into another period of positive growth for 2021. You can see with a peak growth rate of right around 2%. So really think about this expected mild recession as a lull, kind of as a chance to catch your breath a little bit and really to plan for the next rising trend in that US industrial economy. It's not going to be severe and it's not going to be long lasting. So leverage it as an opportunity to think about the future of your business. Make sure your products are correctly positioned. Make sure that you've filled all the gaps in your portfolio and that you've got the right people, the right capacity, and the right business model to take advantage of that next rising trend in the industrial economy as we head into 2021. So how do we know that the US industrial economy is going to slow and then contract? Well, we've got great leading indicators that we leverage to predict what's going to happen over both the medium term and the longer term future with a high degree of accuracy. So in this particular slide, I want to show you how those leading indicator works. So the dark blue line here, that's the historic data for US industrial production. You can see that dots here represent that forecast that I just mentioned to you with deceleration and then a mild period of contraction expected in early 2020. So the first leading indicator I want to show you here is the G7 leading indicator. The pink line is actually the 112 rate of change, which is the month-over-month growth rate. That compares the latest month of data to the same month from a year ago. And the G7 is essentially the 7 largest economies in the world. So it includes the United States. It also has Great Britain and France and Germany. It includes Japan and several others. And you can see that on a 112 rate of change basis, the G7 leading indicator has not only peaked and transitioned to the backside of the cycle, it's actually gone into negative territory. If we look back towards the US and look at the US Purchasing Managers Index, also on a 112 or month-over-month basis, you can see that that too had a peak in early 2018 and has been decelerating and then going negative for quite some time now, more than a year, clearly pointing to some overt downside pressure on the US economy as we traverse over the course of 2019. The stock market is not always the best indication of economic activity, but here the Wilshire Market Cap 312 rate of change, or the quarter-over-quarter growth rate, certainly confirms our expectations of an imminent cyclical peak in the US Industrial Production Index and then downside pressure from that point forward. So it's just another kind of piece of evidence that supports our expectations that the rising trend in the US economy is about to peak and transition to a period of decelerating growth. And finally, the JP Morgan manufacturing indicator, also plotted on the 312 rate of change basis, has a very similar profile as to what we saw in the G7. It peaked in early 2018, then decelerated over the majority of last year, and has actually entered territory when we get into that late 2018, early 2019 timeframe. So what does that mean to Europe? That's what the focus of this particular webinar is designed to be. So let's take a look at the European economy, and specifically the industrial component of the European economy, and what we can infer from what's happening with the data right now and what the leading indicator signals are telling us. So the first thing I want to show you here is the data for the Europe Industrial Production Index, plotted in two different ways. The moving averages for the index, both on a 3-month moving average basis and a 12-month moving average basis, are plotted at the bottom, and the rates of change are plotted at the top. And it's the rates of change that I want to draw your attention to. So you can see that the European industrial economy has been performing at a fairly mild but positive growth rate since basically the end of 2012, the last period kind of the double dip recession that Europe went through back in the beginning of this decade. But more recently, you can see that the peak in the business cycle of the Europe Industrial Production Index has already occurred, and the growth rate has been slowing for at least 2 to 3 quarters. Currently stands at 1.4% expansion on a year-over-year basis. However, we also have an indication that things are going to continue to slide, and you can see that by looking at the 312 rate of change. So the quarter-over-quarter growth rate for the Europe Industrial Production Index has peaked as early as late 2017 and has been declining this entire time. In fact, it downward passed the 1212 rate of change, the annual number, and currently sits at minus 1.2%. What that basically means is that over the next 2 quarters, you can expect further downside pressure on that rate of change on an annualized basis. So this 1.4% growth figure is likely to slide further and perhaps even go into negative territory if the decline in the 312 rate of change continues in the coming months. The Europe leading indicator certainly says that the rate of change decline will continue. So here the 1212 rate of change, the year-over-year growth rate, you can see is now at negative 0.8%, and the 112 growth rate, which is the month-over-month rate of change, is actually at minus 2.1%. That means that this annualized figure will continue to come down, and it certainly means that the outlook for the Europe industrial economy is actually quite pessimistic when we look out 12 to 15 months into the future, because that's typically the lead time between the leading indicator for a given region and the actual performance of the associated production index. There are other leading indicators that point to substantial negativity and substantial pressure on the European industrial economy. So here, the Eurozone Composite PMI Index, this is on a 112 rate of change basis, that's currently at minus 13.3%. The Eurozone specific manufacturing purchasing managers index is now at minus 15.3%, and the JP Morgan global manufacturing PMI shows a negative 6.6% contraction on a month-over-month basis, which the European Union and certainly the European manufacturers rely on global trade and on exports quite a bit more than we do so here in the United States. And that certainly paints also quite a disfavorable picture of what the manufacturing sector in Europe and certainly the industrial economy in Europe overall can expect as we go through 2019. The European Purchasing Managers Index, it really has fallen off a cliff. You can see the significant negativity that we see in this metric. Currently, perhaps some hope can be gleaned in the fact that the last month of data was essentially a sideways movement, but you would have to look back all the way to the last dip of the double dip recession that Europe went through in the beginning part of this decade to see a negative number as substantially negative as what we see in this minus 15.3% figure for that Europe Manufacturing Purchaser Managers Index right now. It certainly does not bode well for the next 12 months in terms of the performance of the European industrial economy. It's a negative signal that we're interpreting here at ITR Economics. If we look at manufacturing specifically in the EU 27 region, you can see a similar message emerge. Currently, it's up 1.6% on a year-over-year basis, but the 312 has also downward past the 1212, and currently the 312, which is the quarter-over-quarter growth rate for Europe manufacturing, is at minus 1%. So although you're not quite seeing any significant decline on an actual moving average basis, which is what we're showing here at the bottom, the rates of change are certainly pointing to further deceleration in the near term and potentially some negativity in the midterm for Europe manufacturing. If we look at the difference between the two major regions within Europe, it's clear to me that the Western European region seems to be kind of bearing the brunt of the negativity. Although it is up 1.3% right now, the 312 is already negative at minus 0.3%. And so that shows that there's more propensity for this to continue to decline in the near term, and certainly the potential that it will go into negative territory as we go into the latter part of this year and into early 2020. Now, if we look at Eastern Europe on a separate basis, the industrial production index for that region is showing some downward pressure, but certainly not anything like what we saw for Western Europe. So you can see year over year, the growth rate is 4.4%. The 312 is below the 1212, but it's still a relatively healthy 3.7% growth. So although that means that there is likely to be some deceleration over the next 3 to 6 months, there is nothing to suggest that we're moving into negative territory for Eastern Europe over the coming 12 months or so. Now, if the data continues to decline and to deteriorate, then that's certainly something that we will reassess. But as of right now, it certainly seems like the opportunities for further expansion are more likely to come out of Eastern Europe than they are out of Western Europe. So with this outlook of slowdown and some potential for negativity early next year in mind, what do you do? If you're exposed to Europe, if you're sourcing from Europe, I wanted to provide you with some specific actionable advice for this phase C or decelerating growth phase of the business cycle. The first thing that you absolutely have to do is develop your own business's rate of change. You have to know where you are on a 312 basis, where you are on a 1212 basis, and what the interaction between those rates of change mean, because that will help you identify when that next trough is approaching so that you can actually kick your investment and your aggressiveness into high gear, take advantage of other people's pessimism, and leverage that next rising trend to grow your business once again. If you need some help with this, certainly feel free to reach out to us here at ITR Economics, and we are happy to walk you through how to do that for your own company. The second thing I want to mention to you is you've got to focus on the segments of your business that are going to be performing the best and also will remain most profitable during this phase C decelerating phase of the cycle. And that means that you've got to understand which of your phase C competitive advantages are really going to resonate with customers that are adapting a more defensive kind of conservative mindset. You also have to start thinking about the next trend. Are you going to have more overt negativity and it's going to be phase D or recession, or perhaps there will be a soft landing for your business? And you've got to start thinking about which of your competitive advantages are going to be conducive to phase B or accelerating growth in your own business cycle. Knowing what those advantages are and then communicating them effectively to your clients will make all the difference in 2019. It's all about what you do rather than what the economy is going to allow you to do over the course of the next 12 to 18 months. You want to adapt some of the conservative approaches, but don't go too bearish. So cash management is going to be important. Start to build up some of the cash reserve and start thinking about how to keep lower inventory levels, because levels of demand are expected to subside as the economy in Europe decelerates. And finally, make sure you ask yourself what you should not be doing. Identify products and services and people within your organization that are not performing up to your standard, and then get rid of them. It does not pay you any dividends to allocate resources to those poor performing aspects of your business. What you really want to do is allocate resources such as your sales efforts, your marketing activities, certainly your promotional campaigns, towards the more profitable and the more active, more successful parts of the company as the economy in Europe transitions through this period of slowing growth and into a mild recession in the beginning part of next year. So with that, I'm concluding the webinar. I hope you've gotten some valuable insights from this short segment. And certainly, please do feel free to reach out to us here at ITR Economics if you would like help with developing your own rates of change or getting an up-to-date picture of what's going on in the European economy or in economies all around the world. Take care, and thanks again.